Welcome, everybody. Thank you for joining. I have with us Katie Bonar. She is the Vice President of Capital Markets at Cameron Stevens. In case you don't know me, my name is Philip Marion. I'm the Portfolio Manager at Foster and Associates and also the Managing Director of the Foster Family Office. Cameron Stevens is a manager that we allocate to within our portfolio, and I thought it would be great to interview Cameron Stevens and get their thoughts on the market and educate people as to what they do. So, with that, Katie, let's start by telling us a bit about Cameron Stevens.
Sounds good. Thanks very much for having me, Phil. So, Cameron Stevens is a commercial mortgage lender. We've been around for almost 20 years now. We were founded in 2004 by Scott Cameron, and prior to founding Cameron Stevens, Scott was one of the founding partners of MCAP, which is one of the largest residential mortgage providers in Canada. And since that time, over the last 20 years, we've grown from about 25 million in assets under management to about 3.2 billion. And we manage that capital, about 80% of it for institutional investors and 20% of it for private investors. And our core business really has always been residential land development and construction financing. And we operate and have offices in Ontario, Alberta, and BC.
So, real estate's obviously something that's widely held and discussed in Canada. And we've been going through the most aggressive rate hike environment in I think, ever at this point. Can you comment to how your strategy is held up? Usually that's a negative impact for real estate.
Sure. So the mortgage trust, which is the fund that is most widely available to both retail and institutional investors, is currently paying monthly distributions at an annualized rate of 10.2%. So from a distribution perspective, it's actually been quite positive because about 85% of our portfolio is indexed to prime. So our loans are structured as a floating rate with a floor. So we benefit from rate increases, and then we have the floor as downside for rate decreases. In terms of performance, one thing we're very proud of company-wide is our loan loss track record. So since inception in 2004, our average annualized net loan losses are only about 12 basis points on the portfolio, which we view as a rounding error. And in the current market in our mortgage trust, we've had no material non-performing loans. So I know there are still, maybe some pain to come, but for the time being, the portfolio is very strong, which we view as a testament to our conservative underwriting.
That kind of leads into my next question, which is the portfolio, the loan composition. So, can you tell us a bit about who you lend to and why?
Sure. So our primary business is lending to developers. So just for clarity, we don't do much in the way of single family residential mortgages. If you want to go buy a house and you need 500,000, we're not the lender for you. We lend to developers looking to build anything from low-rise residential subdivisions to high-rise condos. We do some income-producing assets as well, like office and industrial, but our bread and butter has always been residential development. I would say in terms of portfolio composition right now, our two largest asset classes in our mortgage trust are residential land and residential construction. We do a little bit of inventory and bridge and other asset classes like that, but those are the two largest. And generally, we're looking for developers that have existing bank relationships, but we can provide just a little bit more than what the banks can, whether that's incremental leverage, a little bit more flexibility on items like equity and pre-sales, or a slightly more creative loan structure. That's usually why a borrower would come to us, and they're willing to pay a slight pricing premium versus the banks to obtain that. We really try to be a one-stop shop for clients, so they don't have to go to the bank, get a first mortgage, get approval from the bank, get a second mortgage, and then negotiate with a new lender. So we try to be, sort of that one-stop shop and be creative to give them what they need.
Okay. Has the strategy, due to the changes that have happened with interest rates, have opportunities presented themselves?
I would say one thing we've focused on, so two things actually. One thing we focused on has been geographic expansion, not particularly tied to the change in interest rates, but just in terms of overall strategy. We've made a big push over the last few years to expand our presence in the greater Vancouver market. We've opened an office out there. We've hired a number of people. The mortgage trust in particular is now about 10% of its portfolio is in the Vancouver area, whereas previous it was only about 4%. And we see that continuing to increase. In terms of other items on the current strategy, I would say, we're really staying the course. We feel that our strategy has been very successful for us. We're not making material changes to it, but we do find that there are some additional opportunities to lend to, I would say, more upmarket clients than perhaps we were able to a year ago. And that's because a lot of the banks and some of the large financial institutions are becoming increasingly conservative, which provides opportunities for lenders like us to do, what we call sort of A deals at B pricing. So we get a premium price and we're dealing with AAA clients.
Okay. Um, you must have dealt with some non-performing loans. Can you kind of go into some details about what that looks like from the start to finish of something that's non-performing?
Sure. So, of course, no one bats 1,000. We have had some non-performing loans. I will say in our mortgage trust, we have never had a loan loss. And like I mentioned, we have a very strong company-wide loan loss track record. In fact, even some of the loans over the last 6 to 12 months that have been non-performing, we've been able to get taken out via refinancing from other lenders because our loan to value was so conservative. So that's always nice when you can avoid all the lawyers and the fees associated with the enforcement process. In the cases where we do have to proceed with enforcement, it does differ a little bit depending on the province and depending on the asset class. But at a very preliminary high level, we would typically start with issuing a demand letter and a bankruptcy and insolvency act notice to the borrower. There's usually a stipulated waiting period for them to bring us into good standing after that point. And if that doesn't happen, we issue a notice of sale. And again, there's a waiting period, and then we would proceed with listing the property for sale, which involves, getting two independent appraisals and a number of other technical items. But really what's held us in good stead over the years is that because we're lending at quite conservative loan to values and to good people, we usually don't have a huge issue getting our loan fully repaid with all of the accrued interest and fees. So when you're lending at a loan to value in the 60% range, you have almost a 40% value cushion there.
Do you still have good relationships with the borrowers when the situation like this comes up? I can imagine some borrowers that you've been dealing with for a number of years. How do you manage that type that part of the relationship that could be quite sensitive?
Sure, and definitely it can be sensitive. I would say our first pass at anything is always we want to work with the clients. We're not here to be a loan to own lender. That's not our business model at all. We don't want to put people into default. We definitely don't want to take over properties if we don't have to. So the first step is always to talk to the borrower. Maybe there's some sort of loan restructuring or payment plan or something that we can do to get them back on track. Generally, we find if the borrower is willing to work with us and they have some ability to move the project forward, there's other alternatives than to just saying, we're going to list your property for sale. And typically in those cases, we do maintain a good relationship with the borrower because they remember that we were there for them when they needed some help and we didn't just, pull the trigger immediately and try to collect on their loan. However, in cases where the borrower is not cooperative, not responsive, or just really has hit a wall and there aren't a lot of alternatives, in those cases, sometimes you do have to put the hammer down and go forward because we have to protect our investors' capital first and foremost. In those cases, it's a bit of a mixed bag. Sometimes they understand why you have to do it. Sometimes they're very angry, and that's something we have to navigate from a relationship management perspective. But I would say just given that we have probably over 80% of our business is from repeat clients, so I think that in itself is a testament to the fact that we're really focusing on strengthening and preserving relationships.
All right, thanks. Just a couple of general market questions. In the past year, has the real estate market surprised you at all? Some people were anticipating a decline, things have been going up. Maybe some comments about that.
Sure. I would say that I think we were all a little bit surprised just by the rapid pace of rate hikes. I think we all knew we needed to raise rates to tame inflation. That shouldn't have come as a surprise, but just the velocity with which they occurred was a little surprising to me and I know to a number of others. And then some of the knock-on effects on the real estate market are logical when you look at it from that perspective. Of course, when rates go up by an order of that magnitude, you're going to see a reduction in purchases. You're going to see buyers sitting on the sidelines and people waiting to see how the market shakes out. So I think, am I surprised by the outcome? Not necessarily, but I think just the rapid rate of hikes was something that was not necessarily baked into all of our forecasting.
So for Cameron Stevens, I'm sure you're looking forward and forecasting. How do you protect the portfolio with a recession? Is that something that I'm assuming you plan for? What are some things that you do to safeguard investors?
So actually, it's one of the things where it's no one wants a recession, obviously, but it is something where lenders like Cameron Stevens, I feel like, have the opportunity to stand out from some of their peers. Because although we are, like I said, quite conservative, sometimes, when the market is great, we're putting out, I would say, still above market returns, but someone could compare us to another fund and say, okay, you're at 8%, someone else is at 8.5%. What's the real material difference? But I think where companies like ours shine is really in tough times, because it really is when our conservative underwriting, our proactive portfolio management really comes to bear, and where others in the market, not naming any names, but others have had significant performance issues, we've been, I would say, in very, very good shape. So the downside protection that we have in our portfolio, the underwriting, the stress testing, those aren't just things we do if we think there's a recession. Those are things that we do in and out every day, and we're very disciplined about it. So I think this is just an opportunity for us to really stand out, prove ourselves apart from the competition, and to come through this, a better, stronger company.
Right. So I know that you have been pretty active in the equity side. So Cameron Stevens, over the past few years, has formed an equity capital division. Maybe you can talk about that and some of the projects you're working on.
Sure. So that was something that happened in 2020, was ultimately when we did our first transaction, and we made the decision to form the business when we were sitting at home during COVID and didn't have a whole lot else to do. I thought, why not start an equity business? So what we ultimately did was we closed on our first transaction in October of 2020, which was a townhouse project in Etobicoke. We've since closed on an additional 4 projects, so we have 5 to date, and we hired a gentleman by the name of Sean Fleming to run the day-to-day operations of the business. So while my expertise and Steve Cameron, our executive vice president, and a number of others are more on the financing side, Sean has 15 plus years of hands-on development experience. So we felt it was very important to have someone with that development background be there day to day to run the business. So Sean's doing a fantastic job. Our most recent project that we closed on in July of this year is a condo redevelopment project right in the Yonge and St. Clair neighborhood, which we think is a fantastic location. Really, as a business, we're focused on center ice locations in Toronto specifically. We want to stick to markets that we know and areas that we know, even if there's a dip in the market, will retain long-term marketability and desirability. So we've been very focused on that. We've closed on 3 high-rise residential condo projects with Originate Developments and Westdale Properties. They've been very strong partners of ours. And like I mentioned, we have another townhouse project, and we also have an industrial condo conversion in North York. So really focusing generally on our bread and butter, which is residential development in markets that we know.
I mean, this next question, and I don't know if you're going to be able to answer it easily or quickly, but I mean, what's your outlook for Toronto development? It's obviously a sensitive scenario with some pre-construction environment right now for price per square foot, and if customers can close properly. What do you think is going to happen over the next few years?
Sure. So I agree. I think there'll be some short-term pain. I don't think it's a surprise to anyone that a lot of the sales launches right now, particularly in high-rise, are stalling or not going particularly well. But I would say really we always take a bit of a long-term perspective on things, and we're very bullish on the Toronto market as a whole. You don't have to be a genius to read the headline news every day with the immigration numbers being where they are. You also look at the just shortage of supply, which is a structural issue, not just in Ontario, but all across Canada. So we just, we'll always have some level of underlying demand for units, particularly, like I said, in equity, because we're focusing on those center ice locations in Toronto. We still feel that the fundamentals of the market are very strong, particularly in 2024. If we do see a tapering off or a stabilizing of interest rates, we believe that will bring some confidence back to the market, and we'll be able to, resume business as usual. Again, we're still very active in this market, so it's not as though we've put our pens down, but we're certainly underwriting much more conservatively. So I would say, in summary, sort of short-term pain, long-term gain, fundamentals are strong, and we're strong believers in the fundamentals of not just Toronto, but the Canadian real estate market.
Okay. Well, I think that's all on my end. Thank you for your time. I really appreciate you telling us a bit more about Cameron Stevens and what you have to offer. On one last thing, I want a prediction for today's game for the Jays. What do you think the final score is going to be?
I'm going to give it to the Jays. Against my better judgment, I'm a huge Jays fan, and I'm going to give it to the Jays. But I hope I'm not proven wrong.
That's fine. I'm going to say 4-3 Jays. That's me, but we'll see. Anyways,
Perfect.
thank you, Katie. Have a good time.
Thanks again, Phil. That was great.